Hello and welcome to Investing 101, How to Invest. It seems that many people in today's world don't know how to invest their money. Well, I'm here to tell you that it is surprisingly simple. First, there are 4 basic finance rules that you must follow. If you do not follow these rules, you will never invest successfully. Rule 1, distinguish needs and wants. Don't let your spending habits enslave you. Discipline yourself. Rule 2, live on less than you earn. You will never invest with a negative cash flow. Rule 3, use a budget. This is vital because it will help you follow the other rules. A budget must be written down, be extremely detailed, and you must update it frequently, weekly being the most ideal. Keep track of every penny you earn and spend, and you could potentially see how much money you waste. Lastly, this may be the most important of them all. Rule 4. Start early. Start obeying these rules and investing now. I will show some numbers later in the video that really help demonstrate the importance of time in investing. The sooner you start, the better. Now let's clarify the 3 myths of investing. Some people believe that you must be wealthy to start investing. False. I am a college student who is considered to be in poverty by US economic standards, and I have started investing. Some people think you must be a financial genius to invest. Also false. I am studying human biology and want to be an orthodontist. I am no financial advisor. Learning about investing and actually doing it is one of my hobbies. I've also heard of people who are under the impression that you can't invest until you are out of debt. This is also false. Everyone can and should set aside a small monthly investment even when in debt. Even if it is as low as $5 a month, you can do it. However, you should always do your best to get out of debt as soon as possible. Lastly, be aware this is no get-rich-quick scheme. Investing, getting rich, saving for retirement, they take time and effort. I do not trust people who tell me they can make me rich fast. Now let's talk investing. Why do it? Well, do you want to be a slave to a job forever? We all want to retire early and live comfortably, like this guy. So building a passive income is essential. A passive income is when your money works for you instead of you working for money. It is where you place your money aside in an account and it grows over time. As I mentioned earlier in Rule 4 of Basic Finance, time is your greatest ally. Also, something to be aware of is the stock market has grown by an average of 11% a year since its conception, despite all the recessions. It grows and crashes in cycles, but over time there is a net growth of about 11% per year. So when you see your investments plummeting, don't freak out like this guy. Now, let's see some numbers. Remember earlier when I mentioned the importance of time in investing? Well, now you get to see why. We are going to talk a little math just briefly. Here is an equation that shows how much you will earn on an investment with a monthly contribution. The letter A represents the final amount of money in the account. PMT is your monthly contribution. APR is the annual percentage rate. N is the number of compoundings, meaning the number of times you get paid the return in the year, which is usually monthly. Y is time in years, representing how long your investment is active. Notice where Y is. It is in the exponent. This means the value of your investment will grow astronomically the longer it is active. Here are 2 scenarios. In both we will make the following assumptions. Your monthly contribution is $67. You'll see why that number is important very soon. We'll assume you invest all $67 a month completely in an index mutual fund with an APR of about 11%. We'll learn about index funds later. And of course, there will be monthly compoundings. First scenario. Let's say you invested the $67 a month for 40 years. You would have contributed about $32,000. You would have earned about $544,000 in interest, leaving your account with about $576,000. Second scenario. If you did the same investment for 45 years, then you would have contributed about $36,000. The total interest earned would be about $965,000, leaving your account with a total value of over $1 million. Do you see the difference? 5 more years and an extra $4,000 of your money, and you make an additional $500,000? Now you see why $67 is the magic number. Invest that much monthly for about 45 years, and you could be a millionaire. Before we discuss investment products, I want to clarify that the money with which you invest should be money you are happy living without. Consider your investments an advanced saving account, and that you aren't going to use most of it until you're old and retired. Now, there are many ways to build a passive income. When studying what investment product is best for you, you must consider the risk. Here is our riskometer. For the most risk, you can purchase and trade individual stocks, which can get you phenomenal returns of up to 30% or more, but they have high fees, though I would discourage this unless you are a professional. You can play it a little safer and invest in the stock market through mutual funds. These have significantly lower fees than regular trading. When you purchase a mutual fund, you are essentially investing in a portion of the market, buying stocks from a variety of companies. These funds are actively managed by your broker with the objective of beating the stock market after fees. So it will gain an average annual return of about 10 to 11%, but this could be higher or lower depending on the performance of the fund. Next, we have arguably the best option for new investors, index funds, which have minimal fees. Similar to mutual funds, except instead of your broker actively managing the fund, the money you put in an index fund essentially purchases the entire stock market or index. The objective of these funds is to beat the stock market before fees. So, they should earn an average annual return of between 9 to 11%, depending on the performance. I invest every month into the S&P 500, which is an index of the top 500 companies in the US and is supposed to represent the US economy. I believe that everyone should start investing a small amount every month into an index fund. Another great investment, which could also be considered insurance, is precious metals like gold and silver, which perform similarly to the stock market with average annual returns over time of about 11%. Additionally, real estate is a great source of income, but I don't think that is something a beginner investor should look to purchase, and I would say that buying and maintaining property would be leaning toward active income rather than passive income because of the amount of work it can take. I will hopefully make a video about getting out of debt, in which I will discuss purchasing and owning real estate. You can also purchase CDs or certificates of deposits and bonds. These have lower return and less risk. However, I personally don't believe you should purchase these until you are maybe in your 50s and are thinking about retirement, at which point you should consult a financial planner who will help you transfer your money from stocks to bonds. Hopefully at that point in your life you'll have hundreds of thousands in your investment portfolio. When you are young, you should invest aggressively in the stock market. Lastly, you can keep your money in a checking or savings account, which is federally insured and risk-free, but remember, bank interest on savings sucks. And with the way inflation works, your money is guaranteed to lose value. Now, what are the final steps you should take? Well, the information in this video is a result of my personal research and is therefore my personal opinion. You should do your research before making decisions. There are so many investment options to choose from. Go online, search, open an online brokerage account. There are many companies you can use to access the stock market. You can go to their websites, open an account for free, and start investing for free. Specifically, I would advise you begin with a Roth IRA, which is a retirement account that you pay tax on the money you put in, and you pay no tax on what you earn, as long as you withdraw the money after a certain age, usually 59.5. Once I created a Roth IRA, I transferred a little money from my checking account into this account. Then I used those funds within the Roth IRA to purchase the S&P 500 index, making sure that I reinvested dividends and capital gains. Otherwise, you defeat the purpose of the investment. Finally, once you've done these things, invest a little money every month and watch your money grow. I hope this video has helped you understand a little more about investing. Please like, subscribe, and share so that we can make more people aware of the benefits of investing. Thanks for watching.